Silver investors, silver isn't drifting, it's coiling. Right now, this metal is trapped in a tight box between Fed policy, a nervous dollar, and massive green energy demand. And when that box finally blows open, it's either going to be a powerful breakout or a brutal margin bloodbath for latecomers. I'm OG John AG, and in this video, I'm going to walk you through why silver is back on the radar of big banks and macro funds, how the Fed and the dollar are loading the spring, how green energy demand quietly pulls metal out of the system, and where the real line is between a smart accumulation zone and a classic leverage trap. Segment 1. The setup. Silver's insane year and ugly pullback. Let's start with the big picture. Over the last year, silver has had one of its wildest runs of this cycle, from the low 30s last year to the mid 70s now, a move of roughly 140% year on year. At the same time, from the recent high down to current prices, you've had a drawdown in the 15 to 25% range. So on one hand, short-term charts are full of ugly red candles, intraday reversals, and failed breakouts. On the other hand, the 12-month chart still shows a major repricing up. That combination, huge upside followed by a sharp, noisy pullback, is classic coiling behavior. Big move already happened. Market is digesting it with sideways chop, false breaks, and position cleanup. Segment 2. Fed. The invisible hand squeezing the spring silver is not trading in a vacuum. It's trading in a Fed-dominated world. The macro mix right now looks like this. Inflation is off the highs, but still not back to pre-pandemic comfort levels. Services and shelter remain sticky. Growth has slowed from the post-COVID surge, but hasn't completely rolled over. Markets keep shifting expectations about when and how aggressively the Fed will cut rates in 2026. For silver, the key metric is real yield. Interest rates minus inflation. Elevated real yields are a headwind. They make sitting in cash and bonds more attractive relative to a non-yielding metal. Falling real yields are a tailwind. They push investors toward hard assets as insurance. Each time markets price in faster or deeper cuts, silver gets an energy jolt. Rate-sensitive models reweight into metals. Dollar softens. Hedgers and speculators both bid on dips. Each time the Fed tones down the cut expectations or data comes in hot, that jolt reverses. Those same models cut exposure. The dollar firms up. Silver sees forced selling from late leveraged longs. That constant repricing of the Fed path is one of the main reasons silver feels like a spring being squeezed and released over and over. Segment 3. The dollar's shadow. FX pain versus breakout fuel. Because silver is priced in US dollars, dollar strength or weakness is like a second trade layered on top. When the dollar is strong, foreign buyers have to pay more in local currency for each ounce. Some industrial users hedge less or delay purchases. Speculators lean cautious, especially if risk assets are also wobbly. When the dollar softens, non-US demand gets a tailwind. Silver's appeal as a hedge against currency debasement stands out more. Heading into 2026, the dollar has been pulled between safe haven flows out of weaker regions, expectations that US rates will eventually drift lower. That tug of war is exactly why silver feels coiled. A convincing break to a weaker dollar could unlock a powerful multi-month silver leg higher. A surprise re-strengthening can smack silver back down and trigger another round of margin calls. Segment 4. Gold-silver ratio. Silver's cheap but dangerous signal. The gold-silver ratio, how many ounces of silver you need to buy 1 ounce of gold, is flashing a familiar signal. Recent data and commentary highlight gold has pushed into record or near-record territory as central banks and institutions continue allocating to it. Silver, while up big year on year, still trades at a historically high ratio versus gold in many models. To structural bulls, that means gold has already repriced to the new monetary reality. Silver is still discounted relative to gold and could play catch-up if the macro story stays supportive. That's the hidden opportunity side, but there's a trap. The ratio can stay elevated for a long time. Using it as a green light to go all in right now turns a useful context tool into a dangerous timing tool. In a coiling environment, the ratio is telling you something important. Silver's upside potential is real if macro tailwinds persist, but the road there is volatile, with plenty of room for squeezes against late buyers before any big catch-up move. Segment 5. Industrial demand deep dive. Green energy's quiet pull. Strip away the macro noise and ask what the factories and grids are doing. Silver's industrial demand now rests on 3 big pillars: solar and renewables. Silver paste is used in photovoltaic cells. Even with thrift and attempts to reduce silver per panel, the total installed capacity keeps rising. Major analysts expect solar capacity additions to remain strong into the mid-2020s, which means ongoing silver offtake. EVs and electrification. Each electric vehicle uses significantly more silver than a traditional combustion engine car. Wiring, power electronics, sensors, charging infrastructure and grid upgrades also consume silver in high reliability components. Electronics, 5G, medical, and defense, high-end electronics and 5G require reliable high-conductivity materials. Silver's antimicrobial and conductive properties make it non-optional in many medical and defense applications. Industry reports for 2026 highlight that overall silver demand is expected to remain robust, with industrial usage and investment demand together keeping total offtake elevated. Supply growth from mining and recycling is only modest, not explosive. That physical pull is constant, quarter after quarter. When paper markets dump on a headline, these industries don't stop using silver. They often welcome the lower prices. That is a big part of the coil, structurally tight or balanced physical fundamentals underneath very jittery futures and ETF flows. Segment 6, Supply. Why miners can't just flood the market on the supply side. Silver has its own limitations. Most silver is produced as a byproduct of mining other metals like lead, zinc, and copper. That means, even if silver prices spike, miners can't instantly double output. Their primary decision driver is often the underlying base metal market, not silver alone. Industry commentary going into 2026 points out mine production is projected to inch higher, but there's no sign of a tsunami of new supply. Recycling adds to available metal, but it tends to respond to sustained higher prices with a lag, not to every short-term spike. After several years of underinvestment in new projects and complex permitting environments, supply is not in a position to quickly overwhelm demand if another big macro tailwind hits. So when you combine solid industrial demand, only modest supply growth, you get a market where upside moves have room to run, but also where crowded long positions and hedge fund leverage can overshoot to the downside before equilibrium returns. Segment 7, Positioning, Leverage, and the Hidden Spring. The title we're working with has a very specific warning baked in. Margin bloodbath. That's not drama, it's how silver moves when the spring snaps the wrong way for over-levered traders. Features of current positioning. After a big year-on-year rally, speculative net longs tend to be elevated at peaks as trend followers pile in. ETF inflows and retail interest in Silver Squeeze 2.0 stories add a layer of unstable, fast money positioning. When macro conditions wobble, say a stronger than expected inflation print or a hawkish Fed tone, these positions become fragile. Risk models tighten. Brokers raise margin requirements. Any break of key technical levels triggers a chain reaction, stops, forced selling, and sometimes a flash crash-like move. We've already seen episodes this year where silver dropped around 10 to 12% in a single day after a short-lived rebound, exactly because of that leveraged positioning meeting a macro surprise. That's the bloodbath side of the coil. But beneath that, the structural buyers, industrial users, some long-term investors, and even certain sovereign players often treat those events as discounted entry points rather than exits. Segment 8. Social media, FOMO, and latecomer risk. Silver now trades in a different information environment than a decade ago. You have YouTube channels pushing silver squeeze narratives, TikTok clips showing stacks of coins, and monster boxes with captions like, "Get out of fiat before it's too late." Online communities where every dip is framed as a conspiracy and every rally as proof of imminent systemic collapse. The upside, this community creates a base of long-term holders who are not easily shaken out by a red week. It also keeps silver on the radar of younger investors who might otherwise ignore it. The downside, latecomers often enter not with a framework, but with FOMO. They use leverage they don't fully understand. They buy near resistance after seeing a viral clip, not after understanding macro, positioning, and risk. When the coil snaps down instead of up, these are the accounts that blow up first. That's why the same story, silver is coiling, can be an opportunity for those with discipline and a trap for those with leverage and no plan. Segment 9, Framework. Breakout versus bloodbath. So let's tie this back directly to the title. Silver is coiling, Fed, dollar, green energy. Is this the big breakout or a margin bloodbath? The breakout scenario looks like this. Fed signals clearer path toward rate cuts as growth slows and inflation stays controlled. Real yields drift lower. The dollar softens. Industrial demand stays firm. Solar, EVs, electronics remain on track. Technical resistance levels get taken out on strong volume. Silver pushes through its recent ceiling and holds. Gold-silver ratio compresses as silver finally catches up to gold's move. In that world, silver's coil releases upward, and those who built positions patiently without over-leverage are rewarded. The margin bloodbath scenario looks like this. Fed stays hawkish longer, or inflation data forces markets to price fewer cuts. The dollar finds a new leg of strength as other regions struggle. Silver retests and fails key resistance levels. Bulls don't show up with enough size. Speculative longs, especially retail and some funds, are too extended. A sell-off breaks support, triggers stops, and cascades into a sharp downside spike. In that world, the coil releases downward, and anyone who piled in late with high leverage becomes forced supply. The structural story underneath, industrial demand, limited supply growth, long-term debt, and currency risk, doesn't disappear in either scenario. But your experience of silver over the next 6 to 12 months depends heavily on which side of that coil you're standing on. Segment 10, Practical Positioning for 2026. Here's how to approach this if you're serious about surviving both outcomes. Separate long-term and short-term capital. Decide what portion of your silver exposure is long-term, hedge, store of value, industrial growth story. Decide what portion, if any, is trading capital, short-term, high-risk reactive. For long-term holdings, focus on structural drivers, deficits, industrial demand, monetary risk. Accept that volatility is the cost of admission. Build positions gradually instead of all in at local highs. For trading positions, respect volatility. Assume silver can move 3 tots or 5% in a day and 10% in a week in stressed conditions. Use clear levels from your own charts, recent highs, lows, moving averages, and stick to your risk limits. Avoid maximum leverage. Silver is already leverage. You don't need a second layer on top. Ignore hype, read the map. Hype will always be there. Silver squeeze, end of fiat, to the moon. The real map is macro, Fed and dollar, industrial flows, supply constraints, and positioning. If the coil breaks up, you won't need to be 10x leveraged to benefit. If it breaks down first, you'll still be standing to take advantage of the next setup. You've been watching John AG here, and I'm OG John AG. If this helped you see silver's current phase as a real coiling of macro forces, not just random noise on a chart, hit like so this kind of breakdown doesn't get buried. Subscribe and turn on all notifications, because when the Fed, the dollar, and green energy demand finally decide which way this spring snaps, you'll want to understand whether you're riding the move or being used as someone else's exit.